Welcome to week 5 in financial accounting. We're going to focus on the balance sheet in week 5 and week 6. So week 5, we're going to cover chapters 5 and 6 in the textbook, which focus on the asset section of the balance sheet. So the balance sheet is also called the statement of financial position. And it's one of those things about accounting that many people find frustrating, which is that we have 2 or 3 names for the same item, but it's just something we have to live with. So sometimes people call it the balance sheet, sometimes people call it the statement of financial position. But at the end of the day, what we're really talking about is the basic accounting equation where assets equal liability plus owner's equity. And this is called the accounting equation, or the basic accounting equation. So I'm going to talk about some key things about the balance sheet in general. Then we'll talk about the assets section, and we'll break it down between current assets and non-current assets. So the balance sheet is just a listing of assets. On the left-hand side, or the top side, is just a listing of the assets that show the way the firm has utilized the funds that it has acquired. And firms acquire funds either through investors, borrowing, or retaining the earnings they have. So this is how assets show some of what they've done with those funds. And it's also a cumulative result of past activities. And when we look at it, it's a snapshot on a particular date. So it tells us what we have in cash, inventory, buildings, etc. at a point in time. So one of the definitions of assets that you should know is an asset is defined as something that has a probable future economic benefit, which means that we expect that we'll be able to utilize this item going forward in the business for at least a year and often longer. So if it's less than a year, then typically we're going to expense it in that time period. But if we expect it to extend over 1 year time frame, then we consider it an asset which we're going to have on our balance sheet. So assets, we can think of the things that we own. On the right-hand side or the bottom of the balance sheet, depending on how it's prepared, are liabilities. And liabilities are things that we owe to others. So the probable future sacrifice of economic benefits arising from present obligations. Basically, all that means is what we owe to others. And again, we're going to break out the liabilities between current, and current are those that we have to pay in the current year, and non-current, which are long-term, which are things that we'll pay in future periods. And then the difference between assets and liabilities are, another way of saying it, assets equals liability plus equity. And equity can be called stockholders' equity or owner's equity or just plain old equity. So it's the difference between those assets and liabilities. And when we get to the equity section, we'll see, particularly for corporations, it gets a little more nuanced. We break it up into something called stockholders, paid in capital, retained earnings, and the like. But essentially, when we talk about equity, we're talking about the difference between assets and liabilities. And assets are what we own, liabilities are what we owe to others, and equity is the difference. So if you think about your parents or your grandparents, and most of them probably own a home and or other assets. And so if you were to ask them their net worth or their equity in their house, the way they would think about it is, there's a market value for my house of X. Let's say it's $500,000. Let's say I owe the mortgage company $200,000. So the difference between those, what I own and what I owe to others, is my equity. In this case, to be $300,000. And corporations work the same way. The one difference between what an individual would do, however, and what a corporation does is, as we learned from last chapter or the last couple of weeks, is that when we talk about the value of assets in corporations, we talk about them at their original cost, where individuals, when they talk about their assets, usually talk about the current market value. So as I mentioned, assets can be either current or non-current. And so non-current assets are things that are in the future, and ones that we expect will be with the business over a year. Current assets, which is where we're going to begin this discussion, are those assets which typically become cash, or we can convert to cash within the current year, or within 1 year. So the type of current assets that we have are cash, short-term securities, inventories, prepaid expenses, and possibly accounts and notes receivables. So I'm going to go through most of these so you have a basic idea as to what they mean. Some are obvious, like cash. Everybody knows what cash is. Things like short-term securities, prepaid expenses, inventories. You may or may not know what those are, but those are things that are pretty straightforward. And as we look at your company's income statements, you'll see that most of them have these items on their balance sheet, and you should basically understand what you're looking at when you see these line items. And that's the goal here. Not to make you an expert in any one of these areas, because there are people who do become experts in managing cash, managing inventories, and the like. At this point in our process, we just want to make sure that everybody understands what these things are. And then if you decide to pursue a career in finance, then you would learn a lot more about the management of these particular items and other trade-offs that may occur, and how they're assessed in terms of financial ratios and the like. But right now, we're just going to get to the basic core of what these things are. So one thing you should probably know is that when we look at current assets, there is a method to how they're listed on the balance sheet, and that's in terms of their expected order of maturity or convertibility to cash. So when we look at the balance sheet, at the top of the balance sheet, we're always going to see something called cash, if we have cash, because that's already in the form that we consider the most liquid. And then there's going to be a sequential ordering of the current assets and the non-current assets in terms of how quickly we think they could be converted to cash. So oftentimes, that after cash will be something called short-term marketable securities. And what short-term marketable securities are is when a company has excess cash that they want to invest for a very short period of time, let's say 30 days or 60 days, maybe they can get half of a percentage of interest on it, but it's easily convertible to cash. That would often be the next one. And then the one after that often is something that we expect to collect from our customers in 20, 30, or 40 days, and that's something called accounts receivable. And after that might be inventory, because inventory typically takes us a little bit longer to convert into cash, because first we have to sell it, then we have to bill the customer, then we have to collect the cash. So it takes a little bit longer in terms of the cycle to cash. But you should get the basic idea that assets are listed in their order of how quickly we expect to convert them to cash. So cash, I think, is pretty self-explanatory. There's also something called cash equivalents, which are just basic ways of holding cash that essentially is they're considered being able to convert to cash almost instantly. So again, we don't need to become experts on this. What we need to recognize is that cash is the first thing on the balance sheet because it's in the most liquid form. And so here's just some examples. And one of the things that is mentioned in chapter 5 and 6, and we will actually spend a week on this particular topic, which is the idea of internal controls. So internal controls basically are required as part of preparing financial statements. And what our objective with the internal controls is to ensure that we have integrity and efficiency in the operations. And so one of the big risks that companies have is that things may end up missing, either intentionally or unintentionally. So what companies need to do is put a system in place of checks and balances, and we call this internal controls. And so when it comes to cash, some of the things that are considered part of a solid internal control system is that we make daily deposits of all cash we receive. We make all payments by check so we can trace them down. If you get a bank statement, we reconcile the bank statement. And there's also something called segregation of duties, which means that if I have access to the cash, then I should not also have access to the financial records that record the cash. So we want to separate those two things to prevent collusion. So let's not get focused in on this whole thing around internal controls, because this is also a specialty area. But let's just keep in mind that companies need to put checks and balances in place. And so cash is one of the areas that obviously is very susceptible to risk if we don't have a check and balance in place. So I'm not going to go through bank reconciliations. Hopefully, I'm sure most of you have checking accounts, and hopefully you do your own bank reconciliation. It's basically a way to verify that that you know where your cash is. So, all right, we're going to skip over this. Okay, so the next thing that was mentioned is short-term marketable securities. So you may find this somewhat interesting. When companies have excess cash, but they may need it in, let's say, 30, 60, or 90 days, then they'd like to earn something on it when possible. So as you probably know, if you put money in a checking account, that doesn't earn any interest. So it's sitting there basically unused. So if there's an opportunity, then companies like to earn a little bit of money on it. It may be less than 1%, but it's still something. And so there are often these short-term securities that exist. Might be other companies' paper, might be the T-bills, and so forth. But basically, these are short-term, low-risk, low-yield items. And that's when you see this on the balance sheet of your company, that's basically what they are. They're a temporary holding place where a company has excess cash and they're trying to earn some money above and beyond what they would get with cash, which is nothing. Okay, so the next item that you'll see on the balance sheet is something called accounts receivable. And accounts receivable basically represents money that your customers owe you. And the reason that your customers owe companies money is that when I sell things, I often sell things on credit. So it's very rare, particularly in a business to business, but even in your own transactions, very rare that if you're buying something of beyond nominal value, that you use cash. Typically, you may put it on a credit card, or you may have an account at a particular place, but usually what happens with business transactions is that when MCPHS, for example, buys office supplies from WB Mason, they don't send them a check that day. They place an order online, it gets delivered, and then after it gets delivered, WB Mason will send an invoice to our accounting operations. And usually the terms are, you need to pay me within 20 days or 30 days. And so for WB Mason, that would be an account receivable. And so the same happens with the companies that you're looking at. They sell products to their distributors primarily, or to healthcare institutions, or whoever their customers may be, and they typically will bill them. And that billing is a sale, so they're going to represent that on their income statement. It also ends up in their balance sheet as money that's owed to them by their customer, and that's called the accounts receivable. So one of the things that we'd like, and one of the things actually that companies are measured on, is how quickly they can collect their accounts receivable. So that if there is an industry norm, I'm going to just throw out a number of 30 days. So typically when one company invoices another company for things that they've sold them, they typically give them 30 days to pay it. And so what happens is that we want to make sure that the company is being paid in a timely fashion, because when a company is not being paid in a timely fashion, it creates several problems. First of all, it ties up cash. And so basically that becomes a problem for the company. The other issue that happens if things aren't being paid in a timely fashion is that it indicates there might be something wrong. That something wrong may be that my customers aren't happy with the products that are being sold, or maybe that my own internal operations are not efficient. So one of the things that investors and creditors look at is, do companies collect their receivables in a timely fashion? And that's an indicator that things are flowing well or not well for a particular company. Okay, so we'll probably take a look at that a little bit later in the semester. So the other thing that's mentioned in chapter 5 is this idea of uncollectible accounts. So large companies run into this problem all the time. That some of the accounts that they have will not be collected. So sometimes it's planned that way because some companies are willing to take risks. So if you're in a high risk business, let's say that you're in a business that services, let's say, lower income people, and you know that there's some risk of non-payment due to financial hardship or whatever, then you kind of build that into your pricing and methodologies. Sometimes things just happen that aren't planned. I'm doing business with my customer for years. All of a sudden, they run into financial hard times and they're not able to pay. So in any case, at the end of the day, there are accounts that become uncollectible, and so we have to recognize that. And so when we look at on the balance sheet, you're going to see oftentimes you see net accounts receivable. And when we get to the footnote section of the financial statements, it'll talk about how they determine what percentage of their accounts are uncollectible. It's a big thing in retail, but okay. So, and this just shows how it's shown on the balance sheet. We have gross accounts receivable less allowances for bad debt and net realizable. So net realizable is the amount I expect to be able to collect. So typically when we look at the balance sheet of a company, it's going to be the net accounts receivable, net realizable value. So the other thing to keep in mind is that the longer a debt remains unpaid, then the likelihood of non-payment increases. And so when I had worked for large corporations, typically we would work up schedules over time. If we got over a certain time period, let's say 180 days, then the probability of collecting it usually would be less than 50%. Okay. So the next thing that we'll see on the balance sheet is inventories. And inventories are those things that we own that we're holding for sale to our customers. So a manufacturing company builds that inventory, a merchandising company buys that inventory from their suppliers, but it's still inventory. It's a current asset because we expect to sell it within a year, hopefully much sooner than that. Hopefully we're able to sell it in days or weeks. But in any case, it's those items that we hold that we plan to sell to our customers. So if you walk into a Costco, all the things on their shelves, that's inventory. You walk into an Apple store, all the iPhones that they have, those are inventory. Automobile dealership, those are inventory items. So what's not inventory in any one of those places are the other things they own. So the equipment they use to process transactions, or the desks and other fixtures. That's not inventory because they don't plan to sell that to the customer. So it can be either purchased if you're a merchandiser or manufactured if you're a manufacturing company. So some students feel that inventory should be reported as non-current asset, but that's clearly not the case because we expect to be able to convert it within the current year. So what happens when inventory is slow moving? Typically we have to mark it down to get it out of our inventory. And the worst case is we'd have to write it off. Now, the biggest problem is if I have perishable inventory. So if you've ever gone over to Knott Station and or any place where you see perishable items, food items, you'll typically see this. I'm talking about Haymarket Square, but you'll see that as the weekend goes on, prices start to drop down because they realize that come Sunday at whatever time, 5 o'clock, let's say, that the stuff has no value, and at which case they're going to have to dispose it. So they'd rather get they'd rather get something than nothing. So, and again, we prefer fast turnover as opposed to slow turnover. So there's some accounting treatment that is talked about, which is FIFO, LIFO, specific identification, weighted average. And that basically is a reflection of how inventory is accounted for. So this is very nuanced accounting information. And you should just basically understand the terms. FIFO means first in, first out, which means the first inventory that comes in is the first one from an accounting perspective that I ship out to my customer. And LIFO is the last inventory that comes in from an accounting perspective is the first one I ship out to my customer. And we're talking about financial transaction, not the physical movement of it. So, so that's basically what FIFO and LIFO represent. And then specific identification is if I have very high value items, then I track the specific item. And weighted average just means I'm gonna have an average of my cost as opposed to using one of these other methods. So here's the definition of specific identification. Weighted average definition, cost of goods divided by the units. First in, first out, the oldest goes to cost of goods sold first, and then LIFO is the reverse. The most recent cost goes to cost of goods sold first. So, and then there's periodic versus perpetual inventory, which periodic means that I occasionally assess the value, where perpetual, I always know exactly what my inventory values are and what's on my stock. So